When you hear the words offshore corporation, you might picture secret bank accounts, shady tax havens, or scandalous headlines like the Panama Papers. It sounds like something only billionaires or criminals will mess with. But in reality, thousands of Canadians living abroad are using fully legal offshore companies paired with smart tax residency planning to significantly lower their tax bills. Let me show you how it works, and at the end, I'll tell you how you can figure out if it's the right strategy for you. Now let's take a look at some examples of how Canadians are using this strategy to legally reduce their taxes or eliminate them completely. So meet Liam. Liam left Toronto and became a tax resident of Costa Rica, a country that doesn't tax foreign income. He runs a graphic design business through a Wyoming LLC and gets paid into a US business account. He has no US clients though, which is key to this strategy. And from there, he spends freely in Costa Rica using foreign cards. And the result is he has no taxes in Canada, there's none in Costa Rica, and thanks to the US LLC pass-through rules, there's no US corporate tax either. With his setup, it's a clean exit with zero taxes. Now let's compare that to Jasmine in Thailand. Jasmine lives full-time in Thailand and runs a digital agency. She set up her corporation in Singapore, which generally doesn't tax foreign income if it's not brought into the country. Her profits will stay in her Singapore account and she uses foreign cards to spend in Thailand. And on paper, this is a smart, efficient setup with low corporate taxes and potentially no personal income tax. But there's a twist. As of 2024, Thailand now taxes all foreign income remitted by tax residents, those that are staying 180 plus days a year. The rule is still new and evolving. It's unclear whether income earned in previous years and remitted later is taxed the same way. There's been a lot of pushback with this new rule, and I really think that the government will change it back. Jasmine has to carefully time her remittances and monitor her visa conditions to avoid surprises. Her entire strategy depends on how the Thai Revenue Department interprets the new law, and things can change rapidly. As you can see, there are complications with having such a complex tax structure. But note that these aren't billionaires, they're just normal, smart Canadians who have structured things a little differently and come up with some clever strategies. So how does this actually work? Well, that brings us to the three-part tax triangle. Behind the scenes of all this, you're actually balancing three tax systems. And if even one part of it breaks, the whole plan can fall apart. Think of it like a tax love triangle. Canada still wants to tax you. Your new country might want a piece too. And the country where your business or corporation lives, that's a third set of rules. And as we know with triangles, they can get very messy. First, let's talk about Canada, which is leaving the relationship. Canada is clingy and doesn't let go of relationships easily. You have to legally break up by becoming a non-resident, which means cutting key ties, and some common ways to do this is to sell or rent out your home, cancel provincial healthcare, close Canadian financial accounts, and another key consideration is where your family is located. And then there's the departure tax. You may owe tax on your unrealized capital gains as if you sold everything the day that you left. Skip a step and the CRA might keep treating you like a resident. So make sure you make a clean, cold turkey break, otherwise the CRA can be like a possessive ex by still showing up, still digging through your life, and is definitely not over you. And even worse, your new country could claim you as a tax resident as well. I heard of a story of a high earning consultant who made $300,000 per year but was told to pay double tax in both Canada and the country he moved to due to some poor tax setup. And he had to spend a lot of time and money to fix the problem. And even though he fixed it at the end, it was a lot wasted. And a lot of people mess this up because they're flying blind or they're just so busy with their move that they don't really think about these things. And here at Blueprint Financial, we've helped a lot of Canadians safely navigate this exit from departure tax to international structuring. And if you want it done right, book your discovery call at blueprintfinancial.ca. The next part of the triangle is the new country, which you can think of as your new partner. Once you leave Canada, you need a new home. But it's not just about beaches or cheap rent. You want a country that doesn't tax your foreign income. So for example, you move to the UAE and even if you're earning millions online, they don't tax personal income at all. It's a clear zero tax setup, and that's what makes it so attractive for entrepreneurs. If you choose the wrong partner though, you might get hit with tax on income you thought was safe. The third part of the triangle you must consider is the business or corporation location. Now think about where your company is based on paper, because that determines how your business income is taxed. As an example I used earlier, Liam, he set up a Wyoming LLC, and if you're a non-resident with no US clients, you could end up paying 0% in US taxes. It's cheap, simple, and can keep your income legally separated from both Canada and your new country. But put your company in the wrong place, you could accidentally trigger global taxation and even higher corporate tax than what you were paying, or be stuck with some unreliable banking. Now that brings us to the question, what is territorial taxation? And here's the secret sauce. So territorial taxation means a country only taxes income earned within its borders. So if your money comes from abroad and you don't remit it in the wrong way, you might end up paying nothing locally. So for an example, countries like Panama and Georgia will let you earn from Canada or the US and won't tax you on it. Some places like UAE take it further and don't tax the income at all, up to a certain point. And if you're seriously thinking about leaving Canada, I put together a free guide on the 7 biggest CRA tax traps Canadians face when moving abroad. You can grab it at the link below. So here are the 3 big decisions you must get right. Decision number 1, where you're a tax resident. Now this is the foundation of the whole strategy. The key is you want to live in a country that either has no personal income tax or very low, or uses a territorial tax system which only taxes local income. Some examples to consider are, as I mentioned, the UAE or Dubai. There's Panama, Paraguay, Georgia, which have territorial systems. Then there's Thailand, Malaysia, and Portugal. But rules have changed recently, so be careful and mindful of them. There's also the Philippines, which has been gaining traction recently, which has a mixed system depending on your visa and residency status. So it's not just about cost of living, it's about how much of your income they want to tax. Key decision number 2 is where you set up your company. This determines where your business income is taxed. Even if you live in a tax-friendly country, don't assume you should open your company there. This can create some unexpected tax and legal issues. Some examples to consider are, like I mentioned, Wyoming LLCs, which has 0% US tax for non-residents. There's a UAE free zone, which has 0% corporate tax plus residency visa. Then there's Singapore and Hong Kong. While you might not be able to get down to 0 taxes, it's still very reputable with territorial tax systems in place. Then there's Estonia, where tax is deferred until profits are taken out. There's also Panama corporations, where there's no tax on foreign income, but banking is a bit tougher now, so be wary of that. You want a company set up that plays nicely with your residency and keeps the CRA off your back. And here's key decision number 3 is where your money comes from. This is the sneaky one, because even with a perfect setup, Canadian source income can still get taxed. The CRA might still come after you if you're earning from Canadian dollars, work is done in Canada, there's contracts, servers, or ads linked to your business in Canada, and if you didn't properly sever ties. So here's a pro tip, focus on non-Canadian clients if possible, so places like the US, Asia, or the EU for a cleaner tax footprint. So why you need all 3 of these to work together, think of it like a puzzle. There's your residency, so where you are taxed, then there's your company location, where your business is taxed, and your income source, what might still be taxed by Canada. There's no one perfect setup, but get all 3 of these working together and you could dramatically reduce or eliminate your global tax bill. So I want to talk about the pitfalls, downsides, and what can go wrong. Now, while this whole strategy might sound like a tax cheat code, and while it can be if implemented right, it's not that simple. Because even if you get one part wrong, it can completely backfire and leave you paying more in taxes than if you just stayed put. So let's take a look at some common mistakes that we've seen. Probably the biggest one is that you didn't sever your Canadian tax residency properly. You think you left Canada, but you didn't cut the right ties. And you didn't do it properly by filling out the right forms. The CRA will come after you for that. And some ways that they might rule against you are, for example, you still have a house or bank accounts in Canada, even a primary resident or a Canadian credit card can raise red flags, and you didn't file a departure tax return. So you're supposed to tell the CRA you've left, and if you don't, you're still taxable in their eyes. Another mistake is you moved to the wrong country. So if your country taxes worldwide income, you could still potentially get double taxed. Another way is you set up your business in the wrong place. This can trigger corporate tax in your country of residence and possibly in Canada too. Another way is if you use an offshore corp while still a Canadian resident. That's one of the fastest ways to get audited and penalized. So for example, Elaine moved to Thailand, she never sold a Toronto condo, she kept using her Canadian bank account, and she didn't tell the CRA she was gone by filing a departure tax return. And they said, nope, we're still claiming you as a Canadian resident, so full taxes applied to her. So now she's living in Asia and still paying Canadian taxes, which was not what she wanted. And don't forget about the costs. You'll need things like international tax lawyers, accountants, maybe a local fixer or an incorporation agent to set up all these things. Plus there are annual corporate fees, reporting requirements, and banking headaches. And it's definitely not something you want to DIY just by reading a couple of Reddit threads. So who this strategy is actually for? And I want to be honest here, this is not for everyone. So who should consider this kind of setup? Well, the people we see commonly for this is if you're a location independent entrepreneur or consultant of some kind. So for example, you run a remote business with international clients and you're already mobile. This is definitely in your wheelhouse. Another criteria is if you're planning to leave Canada permanently or long term. This isn't for snowbirds or people doing, say, half-year escapes. You'll likely need a clean break to become a non-resident. Another one is if you're earning enough to make the strategy worthwhile. You'll have to do a cost-benefit analysis because there are costs to setting up a structure like this, and there are downsides as well. If you're pulling in, say, over 100K Canadian from your business or investments and your lifestyle is quite portable, this can save you a lot of money each year. If you're making under 40,000, for example, it's probably definitely not worth the hassle and costs. The next criteria is if you want more global freedom, not just tax savings. This isn't just about paying less tax, it's about gaining access to, say, alternative banking, asset protection, and full lifestyle flexibility. Now let's bring all this together because I know we went through a lot. So what does this actually look like if you do it right? Well, if you leave Canada properly, cut residential ties and file your departure tax return, settle in a country that doesn't tax your foreign income, set up a business in a low tax jurisdiction where your profits are either exempt or deferred, and you could use, say, global banking tools to manage your money efficiently and stay 100% compliant. This could all lead to a very successful strategy. This isn't just about paying less taxes, it's about building a smarter, freer life. And if you want a personalized strategy that helps you leave Canada the right way and stay compliant across borders, we'd love to help. Because as we like to say here at Blueprint, build the life you want with the right blueprint. So head to blueprintfinancial.ca to get started, and don't forget to like and subscribe. YouTube thinks that this next video on the screen here is perfect for you, so check it out.